Barclays shares are trading at roughly 453p. Jefferies, one of the major institutional brokers covering UK banks, has just reiterated a buy rating with a price target of 590p. That is a 30% premium to where the stock sits right now. 15 out of 18 institutional analysts covering Barclays currently recommend buy or outperform. And yet the stock has been pinned near GBX 450 for weeks, unable to break higher. That gap between institutional consensus and actual price behavior is the central question of this analysis. It is not simply a case of the market being wrong. Markets are not usually wrong about something this obvious for this long. When a stock sits 30% below its institutional target with near universal buy coverage, the price is telling you something that consensus is choosing to look past. In Barclays' case, that something is a Rosen Law Firm investigation flagged in the week of 26 May. The probe was noted publicly, and it was enough to keep the stock anchored near GBX 450. But the Rosen probe is not the whole explanation. The deeper reason the stock cannot break higher is that the bull thesis depends on a sequence of external events that have not yet been confirmed. The bull thesis runs as follows. Barclays reported a 6% rise in group income to £8.2 billion in March. It raised its return on tangible equity target to above 14% by 2028, up from a prior target of more than 12% by 2026. It pledged to return more than £15 billion to shareholders between 2026 and 2028 through buybacks and dividends. That is an unusually specific and aggressive capital return commitment for a bank of Barclays' size. It signals that management believes forward cash generation is visible enough to make that commitment without jeopardizing the balance sheet. But visible under what assumption? The assumption embedded in that commitment is a macro environment stable enough for UK retail banking and mortgage lending to generate the returns that fund the £15 billion. That assumption is the one the market is currently unwilling to price at full value.
On 29 May 2026, Barclays cut its mortgage rates across the board by up to 0.43 percentage points. On the same day, Natwest cut its rates by up to 0.54 percentage points. Santander had already moved similarly. This simultaneous repricing by three major UK lenders on a single day is not a coincidence. It is a direct transmission of a single geopolitical signal into domestic bank product pricing. That signal was a reported 60-day memorandum of understanding between US and Iranian negotiators, as reported by Axios on 29 May. The MOU extended the current ceasefire and opened formal negotiations on Iran's nuclear program. The market immediately treated this as a rate path signal, not just a geopolitical one. The mechanism is direct. Iran's closure of the Strait of Hormuz triggered a global energy shock. UK households are facing a £200 rise in energy bills next month, as Ofgem's price cap responds to higher wholesale costs. The Bank of England held rates at 3.75% in March in a unanimous decision, specifically citing the risk of war-driven inflation. The BOE warned in April that UK inflation could reach 6% in the worst-case scenario. In that environment, Barclays cutting mortgage rates by 0.43% is a bet that the worst case is fading. The bank is accepting the swap rate signal, which reflects market expectations for future interest rates, over the BOE's cautionary hold. Jefferies' chief European economist Mohed Kumar made the chain explicit. He forecast that if a peace deal is formally signed, the rates market would react more strongly than equities. He projected the Bank of England's next move would be a cut, not a hike, with rates falling to around 3% by the middle of 2027. For Barclays specifically, that forecast is load-bearing. The bank is in the middle of shifting its risk-weighted assets away from lower-return investment banking toward UK retail banking and mortgages. That shift was made in anticipation of a rate environment where UK retail banking generates higher returns. If Jefferies is right about the BOE path, the RWA allocation accelerates the bank's return to its 14% ROT target. If Jefferies is wrong, if the Iran deal collapses and energy prices spike again, the same RWA shift puts Barclays directly in the path of the storm it was trying to avoid.
Barclays has structured its capital return program as a three-lever machine. The first lever is direct capital returns, more than £15 billion to be returned to investors through buybacks and dividends between 2026 and 2028. That cash comes from profits and from assets the bank is no longer deploying in lower return businesses. The second lever is the RWA reallocation. The bank is moving risk-weighted assets from investment banking toward UK retail banking, consumer finance, and mortgages. This includes the Best Egg acquisition and a partnership with Tesco Bank. The shift is designed to improve the bank's income credentials by concentrating capital in segments where the return on equity is higher. The third lever is AI-driven cost reduction. Barclays is investing in artificial intelligence and digital tools to cut operating costs, with the intention of freeing more capital for distributions and buybacks. These three levers are interdependent. The capital return only flows if the RWA shift delivers the higher returns that fund it. The RWA shift only delivers higher returns if the UK retail and mortgage market remains a viable lending environment. The UK retail and mortgage market remains viable only if inflation stays manageable and the BOE does not raise rates. This is the chain that Barclays management committed to when they announced the $15 billion target. It is also the chain that the Iran conflict interrupted. When the Strait of Hormuz closed and oil prices spiked above £107 per barrel, the probability of a BOE rate hike increased sharply. Nearly 500 homeowner mortgages disappeared from the market in days as lenders pulled deals. Average mortgage rates broke through 5%. Deal lifespans fell to a record low of 8 days. In that environment, the RWA shift into mortgages looked like a mistimed trade, not a strategic upgrade. The Iran peace deal MOU changed the probability rating, but it did not confirm the outcome. The deal still awaits Trump's final sign-off as of 31 May. The verification point for Barclays holders is specific and near term. If Trump formally signs the MOU and oil prices fall back toward 80 to 85 pounds, the swap rate signal that Barclays and NatWest priced on 29 May will be confirmed. The mortgage repricing sticks, the BOE cut path opens, the ROT to 14% timeline compresses. Barclays at 453p with a confirmed rate cut cycle and a delivered $15 billion return program is structurally mispriced relative to Jefferies' 590p target. If the deal collapses, the same analysis runs in reverse.
Two distinct reasoning frameworks are simultaneously priced into Barclays at around GBX 450. Each framework leads to a radically different valuation conclusion. Understanding the premises behind each framework, not the surface conclusions, is what the GBX 450 ceiling actually represents. The Bull framework premises the following. The Iran ceasefire becomes a formal peace deal. Oil prices normalize. Energy inflation fades. The BOE cuts rates to 3% by mid-2027, as Jefferies forecast. Barclays' RWA shift into UK retail banking and mortgages captures a higher return lending environment. ROTE reaches 14% by 2028. The £15 billion shareholder return is delivered in full. The Rosen Law probe concludes without material financial penalty. Under those premises, 590p is not an aggressive target. It is a reasonable multiple on delivered returns. The Bear framework premises the following. The Iran deal fails or is partial. Oil prices recover. Energy inflation becomes entrenched. UK inflation reaches 5 to 6%, as the Food and Drink Federation's warning about food inflation materializing by end 2026 proves correct. The BOE raises rates, not cuts them. UK mortgage arrears rise. Credit losses appear in Barclays' freshly expanded retail book. The Rosen probe expands and introduces legal cost uncertainty. Under those premises, Barclays at 453p is not cheap. It is correctly priced for the risks that management's optimistic strategy has loaded onto the balance sheet. These two premises cannot both be true, but both are currently reflected in the market price. The GBX 450 ceiling is where the probability weighting between them is currently balanced. The article in Motley Fool noted the unstated premise behind the bear case directly. The bear case is not that Barclays has failed to improve. It clearly has. The bear case is that the improvement was achieved during a window of conditions that may not persist. The 29.7% share price gain over 12 months already prices the improvement. What it does not price is whether the improvement is permanent or cyclical. That is the question the Iran deal MOU forces into the open. The Rosen probe is a near-term headwind, but it is not the fundamental determinant. The fundamental determinant is whether Barclays management's macro assumption, the one embedded in the £15 billion commitment, turns out to be right. The observable verification point is the formal signing of the Iran deal and the subsequent BOE rate path. If swap rates fall further and the BOE signals a cut within the next 2 quarters, Barclays holders have their answer. The 30% gap between 453p and Jefferies' 590p target will not close on analysis alone. It will close when one of the two premises is falsified by incoming data. The 60-day MOU has started that clock. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.